I used to call them breaker blocks, order blocks, origin blocks. Now I just simply call them levels because they are exactly the same thing. Just the levels are more precise because it's where inefficient delivery happened and we're filling it into the level, which offers a higher probability. What you see over here is traders getting caught. I mean, it's sad to say, but with this pattern, you're essentially profiting on traders getting caught. Now guys, I know the frustration that comes with trying to achieve it all in trading. I know that the market is very, very hard, and there's no denying that. The market is not for the weak, and it will take your money if you're not prepared for war. What I'm going to be showing you in this video should really be considered a gift, because if you follow this pattern to the T, you will never have to work a day in your life. You are going to be able to execute trades on a weekly basis with this pattern that are going to yield you a high win rate with a high probability with little effort, as long as you're able to identify the pattern correctly. It's going to cover every contingency that you will need to make it work. There's not going to be room for questions when it comes to this pattern after you've watched the video, and if you watch it till the very end. So hopefully you guys enjoy the trading pattern that has a 70% win rate, and I leave you on with the video. What you're seeing in front of you now is my trading platform. I thought it was particularly necessary for me to be transparent with what I do and show you an actual entry on the pattern that just happened to occur 2 days ago, so you would have been able to capture this move. Now the red arrows is where the positions were opened, and the blue denotes where the positions were closed. This pattern requires 2 time frames. One, you require the first time frame for pattern identification, and the second time frame you're going to require for trade execution. So let's jump into the daily, because in this pattern and strategy you're going to be using the daily and hourly chart. You're not going to use anything else, and that's the beauty of this pattern. It doesn't require multi-time frame analysis besides 2 single time frames that work with a very high degree of probability very well with each other. So let's dive right into the daily, and let's zoom out so I can show you the pattern. The pattern you're looking for is this exact candle right here. Now, why is this particular candle relevant, and what does it indicate? Because this pattern can be used for both buys and sells. In this particular scenario, that candle that I've highlighted in red represents an opportunity to go short. The reason for it is the candle formation. Obviously, we don't get any more information than that. And what does the candle show? First and foremost, it shows that we've grabbed liquidity below previous day's highs. So that's something that needs to happen in order for this pattern to be valid. Number 2, we've seen rejection. In this case, because it's a bearish pattern, you want to see rejection from the upside, suggesting that traders have been getting caught buying up off the previous day's highs, and we're now seeing rejections because steppers have stepped in, and now we're gonna take them to the other side, which is what most of my trading concepts are based on. What else do we need? We need a small body candle. It cannot be a large, big, wide-ranging candle for this pattern. You need a small body candle that shows, once again, rejection on the upside and a clearing of liquidity, which we do see with the clearing of these previous 2 days highs. Now, once you have that, you then have to jump into the hourly in order to execute the trade, which is what I did on this exact trade. Now, the trigger point is technically and usually the wick low here. This is where you're going to be looking to execute once this candle fully forms. Although, once again, you can lean on naked levels on the hourly, which we will be showing in a second. But as of now, I just want to determine the basics of the pattern so that no one is confused. Number 1, you need to have cleared liquidity on the upside, which we do with previous day's highs here. Number two, we need to see rejection coming in from sellers on the upside. Number three, we cannot see a big body candle because otherwise you would consider the move to be over and it wouldn't make much sense to trade this pattern anymore. So once we've correctly identified the pattern, once again, it being this candle here, we can now jump into the hourly for executions. And I'm going to be giving you clear rules and guidelines that you can follow. So once again, this is the next day where you go and look for an entry. And the rule here is rather straightforward. All you're going to be doing is looking for a level to sell a retracement into. Now, I call them levels. I used to call them breaker blocks, order blocks, origin blocks. Now I just simply call them levels because they are exactly the same thing. Just the levels are more precise because it's where inefficient delivery happened and we're filling it into the level, which offers a higher probability. What you see over here is traders getting caught. I mean, it's sad to say, but with this pattern, you're essentially profiting on traders getting caught. When you look at this bit of price action on the top, you see this exaggerated wick. You know that there's buy positions that were opened right here, and your idea is that we're going to be taking those traders on a ride to the downside and you're going to profit from them. So once we know that we have our retracement, we need to identify the levels, and once again we're looking for naked wicks on the hourly time frame that constitutes a level to go short. What do we see in this case? We see naked levels here to go short, and we see naked levels here to go short. So you basically have two areas to be going short, and what I tend to do is denote it with a blue box as such to know that within this rectangle I need to be going short. And once again, I don't wait for a lower time frame confirmation. I execute on the hourly. I place a limit order and I take the trade as it is. Now, the question you may have is, how do you actually target on this pattern? And it's rather simple. Since the pattern is appearing on a daily chart, you are going to be targeting the next daily liquidity pool. And in my opinion, that was exactly here. This wick low there of this bullish candle is the next high probability trade. If you're looking for high probability with a high risk to reward ratio, you have to target here at this level, which is the next area of interest on the daily chart, because the pattern appeared on the daily, you're executing on the daily. Now that we understand where we need to target, let's go back to the hourly and let's look at the actual executions. And you can refine this to the hourly level, which is what I tend to do. So I wait for the pullback into my area. As soon as we get there, I sell. I did add another position right there on this bearish candle. Let me actually show it to you. Right here is where I added my second entry because we've closed below the level with a strong bearish candle. That means that the probability of a winning trade have increased, and therefore I want to press my advantage in the markets. We see that the market pulls back to your entry and you take the short. Now you target the next daily level, as you can see here. The reason why you see this position being closed out before the level is due to the fact that this happened to fail during an unemployment data being released on the Australian dollar, which happened to be very volatile and resulted in potential slippage and spikes. But otherwise, you trade till this low here. You go 1 pip below the low, you take your profits and you don't extend it any further. Now, furthermore, with this particular setup, although not necessary, if you take a fib from the high to the low, you can see that the level is lining up with a 50% pullback, which is discount, right? So you're selling discount with a higher time frame buyers, with an hourly naked breaker block or level, whatever you really want to call it, into the next daily pool after traders have gotten trapped. So you can just imagine how big the probability is to have to achieve a winning trade. This is one of the highest trades you can execute on. It offers a very big risk to reward ratio more often than not, and you're going to have a very high win rate if you're able to execute this effectively. Let's now get rid of the fib. What else do we need to do? We need to understand our stop loss placement. Now, our stop loss placement is always going to be based on the hourly, and it's going to be based on thrust candles, which are the big candles, such as this one, that close through the levels. Now, in this case, I thought that this particular stop loss beyond this candle high was a little bit too tight. And looking in hindsight, it was. So what I did do, once again, is place my stop above this candle here. And you might think, that's a bit odd. Why there? Why not above this swing? Well, number one, I never place my stops above the swings because I don't want to be liquidity. And number two, it doesn't make much sense. You're looking for thrust candles that close through levels. So in my eyes, this bearish candle here closed through these minor lows here, and therefore became my stop loss above the candle high, which is what you need to do. Remember the foundation. Step number one, you identify the pattern on the daily chart. It needs to be as described, and the opposite would be true for bullish scenarios. Step number two, to jump into the hourly, you denote the daily wick low. Once again, I'm going to be showing you that very quickly here. The daily wick low being there, right there. You denote that level on your chart. And once again, once you have that done, you can jump into the hourly and you look for a naked wick to trade off of, which in this case was particularly good over here because we had a stack of lows and confluence. So there was a high probability that this trade was going to be a winner. And that's all about the pattern. If you trade this pattern effectively, you will achieve a 70% win rate with a very high risk to reward ratio.